Hey everybody, it's Larry Berman here. I've got a great graphic to share with you before we dig into the chart room. It was shared with me, came out of data produced by Goldman Sachs from their economics team. Well, let's have a quick look at this. It explains a lot about what's going on in the economy today. So what this graphic does is it takes the last 3 years and it looks in the change in real disposable income. So it's the income broken down by cohorts. So bottom 20% of income in earners, next 20%, next 20%, next 20, top 20, right? So in quintiles, 20 percentage groups for 2022, 23, 24. And so what you end up seeing here is everyone's working. We're at full employment, generally pretty strong. But really it's the bottom end here and the bottom half in general that are really struggling. Now, real incomes have improved because inflation has come down. But for the bottom end, real incomes haven't improved, a whole lot. And really it's that, you get a raise, but if inflation's going up more than that raise, you're not better off that year, you're worse off. That's the real income effect. And so you can see really at the top end, it is what it is. So, you have this bifurcated economy. I think it's going to mean a lot this year as we get closer to the election. But this also underscores why the average stock is doing poorly. And there's a concentrated driver moving equity markets. It appears when you look at the main averages that the market's melting up here. But when you look under the hood, you see something very different. So let's have a look into the chart room. So on a year-to-date basis, we're looking at 3 indexes and an ETF here. The BM7 is the Bloomberg Composite Mag 7 Total Return Index. That's the red line. And you can see in February, it's just rocketed up in a big way, led by NVIDIA. That's the AI story. It's driving everything at this point. It doesn't matter what they say or what they do. And there was more news out, on Friday about them looking to go into some other sectors and being disruptive and that kind of thing. Compared to RSP, which is the equal weight S&P 500. So that's our worst performer. So the average stock now, the last couple of days has turned positive, but generally speaking, in the US, the average stock, if you include the whole index on an equal weight basis, is still down on the year. Small caps having pretty bad performance. If you take the total world index that has a lot of this in it, weight-wise, you get the white line here. And then if you look at the concentrated tech index, the NASDAQ, you get the yellow line here. So it really is a small group of stock doing all the lifting, not unlike you see with the economy where the top 20, 30, 40% of income earners are doing very, very well on a year-over-year basis in terms of their income growth, so they can spend more and i.e. boost the economic activity compared to what we're seeing at the bottom end. Loan losses are going up, delinquencies are going up, boom, the stock market's going to new highs. We've got 2 hot wars going on. You've got all kinds of inflationary concerns. You've got the Fed terrified to cut interest rates, yet markets are melting up here. Thought this would be an interesting way to end the week here. I took the QQQ and I took a 10-year, basically look back to 2014 to today. And what is the performance of the average stock in the NASDAQ? And I'm going to give you some insight into some of the names I'm holding at the moment. So at the moment, I'm short NVIDIA, and it's killing me right now. But I'm a relative value investor. I'm not a momentum investor. I'm short Tesla right now as well. So if you look at what's done well in the last decade, in particular recently, look at those numbers, right? Now, 10 years ago, did you want to own NVIDIA? Maybe if you were a gamer, but maybe not. I think Tesla, from where we are now, fair value where I like to buy it is half at least of where it's trading today. When does it get there? I have no idea, but it makes no sense to me. They are a car company. Yes, they do other things. Yes, it's innovative. Yes, it's Elon Musk. I get all that stuff, but at the end of the day, they're now in the competition phase of cutting prices to sell cars. And that, to me, deserves to trade at a multiple of 15, not 50. What do I own today? I own Walgreens Boots Alliance. I own Keurig Dr. Pepper. I own Kraft Heinz. I own Baker Hughes. The worst performing stocks in the last decade that are in the NASDAQ 100. Why? Because I'm a relative value investor. And when the bubble pops, whenever that might be in some of these names, where's the money going to go? Hands up, folks. It's going to go into the undervalued stocks. The identical thing happened in the bubble environment of 2000. Warren Buffett, value guy, underperformed for 2 years in 98 to 2000. Bubble burst, stocks fell, Warren Buffett went up. So the money's going to rotate back to these names. When is that going to happen? That's the debate that goes on now. Easier financial conditions probably actually help burst the tech bubble than fuel it at this point. When you think about it, money's going into the names because they're working and the only thing that's working. But when money gets easier and the economy broadens out a little bit, I think that's going to help the average stock more than it's going to help the only ones that are working at the moment. Anyways, that's my thesis for what it's worth. Next week, I'll be at the big ETF conference in Florida. Hope to have some good ideas for you coming out of that. And we'll be doing our show from that event on Monday on BNN. So looking forward to all of that coming up next week. Have a good one, everyone.